Alpine Macro. Thanks very much for joining us alongside Alan Small here. Let's start with the currency story and what you've been seeing in the market today. Walk us through just the tone of trading.
Sure. Obviously very bearish on basically any currency outside of the U.S. dollar. It's the Canadian dollar that's down, the Mexican peso, the euro, generally broad-based strength of the U.S. dollar. And it's a typical reaction you would expect from this increase in tariffs. Tariffs are not going to alleviate the U.S.'s trade deficit, so the dollar has to appreciate as an offset. And of course, we get risk off. And if it's a risk-off environment, it's usually the U.S. dollar that benefits from so-called safe haven capital flows. And like you said before, even though, ironically, the U.S. is the cause of the crisis, the dollar still benefits. By the way, this is the same thing that happened in the GFC back in 2008. The financial crisis was concentrated in the U.S., and nevertheless, the dollar rallied as safe haven capital flows flocked to the U.S.
And so I guess if people are trying to figure out what's going to happen to, by comparison, the Canadian dollar, because, before we started factoring in new tariff developments, we were already in a situation where the Canadian Central Bank had cut rates and indicated they were ready to continue cutting rates. And certainly that could be more aggressive depending on what happens with tariffs, whereas the U.S. Federal Reserve has been monitoring the inflation story and seems mindful of the threat of inflation returning amid lower interest rates. So there was already a differential, it seemed, between rate policy in Canada and the U.S. But now with the Canadian dollar below 69 cents, what's the buzz on the street right now?
Yeah, it really is. How long are these tariffs going to last? So like you said, we already had this divergence in monetary policies taking place before the tariffs. And they could worsen now after the tariffs if they stay in place. Just as an example, last week when the Bank of Canada announced its policy decision, it also released its monetary policy report. And in that report, it had a scenario where it assessed the impact of tariffs on the Canadian economy. So the scenario that the Bank of Canada laid out was that there was a 25% across-the-board tariff on Canadian goods. There's a similar retaliation by Canada. And in that scenario, Canadian GDP takes a hit of 4.5% over 2 years. So basically saying that the Canadian economy will fall into a recession if these tariffs persist. And if that happens, then of course the Bank of Canada will eventually be forced to ease policy much more aggressively as an offset. And that will obviously play into weakening the Canadian dollar further. So the question is really about these tariffs. Are they going to stay with us or not? If they stay with us, then there's more downside for the Canadian dollar. If something comes out and they're taken away, then I'm sure we're going to get a sizable relief rally.
Yeah, the relief rallies would be great. For me, as John said, I think the Bank of Canada was already cutting rates to try and stimulate our economy. And is it really just as simple as that? Just keep cutting rates till we get some stimulation. Obviously, with tariffs now looking to take hold in the next day or so and beyond, how low can the Bank of Canada actually cut before we actually start to see inflation coming onto our shores, right? Not only are we seeing the possibility of inflation because of the tariffs, but if we keep cutting and more and more things become more and more expensive as we import them, wouldn't that just kind of feed back into the loop? And is it not too far-fetched to see a 65-cent dollar in the not-so-distant future?
I wouldn't rule it out, of course, if the tariffs stay with us and the Bank of Canada keeps slashing interest rates. There's certainly potential for the currency to weaken. On the inflation side, yes, tariffs in themselves can push up the price level, but if the economy is going into a recession, there's going to be an offsetting disinflationary force. So then it's a question of which is going to dominate. Is it going to be higher costs for imports because of the tariffs, because of the weaker Canadian dollar, or is it going to be the decline in domestic price pressures because the economy is going into a recession? So I don't think it's very clear that it's necessarily an inflationary outcome for Canada. They're two opposing forces at work.
Now, when it comes to the fixed income world, I just want to get a sense on what are some of the levels to be watching. We've highlighted how the president likes to keep tabs on the stock market, but I think some of the general levers to watch in the market in terms of reading sentiment amongst Wall Street are in the fixed income world, whether it's the 10-year yield or something else. What are you going to be watching to determine how basically the global markets at the end of the day feel about where this tariff story is going to take the economies of countries around the world?
Sure. For example, one of the interesting price actions overnight is that Treasury yields are down. So, we hear so much about tariffs being inflationary, and yet, we have Treasury yields going down. So, of course, part of it is because it's risk off. If stocks are down, people need to go into some other asset class, and Treasuries are viewed as a safe haven. But more generally, we at Alpine Macro have been saying that tariffs are not necessarily inflationary. Yes, at worst, they can lead to a one-time increase in the price level, but a trade war leads to a contraction in global trade and global economic activity. And that's ultimately deflationary. And the example that we keep highlighting historically of this taking place is the 1930 Smoot-Hawley tariff. It exacerbated the Great Depression. The U.S. was putting on tariffs, trying to protect its economy after the start of the Great Depression, but it actually worsened things because of retaliatory tariffs, and it led to a massive contraction in global trade, and that exacerbated the Great Depression and added to deflationary pressures. So, but if the bond market is continuing to rally, it will be telling us that the downside risks to growth are offsetting the potential inflationary impact from higher tariffs.
Harvinder, thank you very much for your time. Obviously, a lot of moving parts this morning. Good to get your insight.